Welcome to the New Silk Roads podcast. In this podcast, Professor Richard Griffiths updates his recent book on the Maritime Silk Road by looking at the impact of the coronavirus pandemic on seaborne trade and shipping in the first half of the year 2020. He also explains the highs and lows of the oil tanker market as it reacted to changes in sanctions and the price war that broke out. And if you are interested in more content, take a look at our website, where you can find podcasts, books, and online libraries dedicated to the New Silk Road. You can also join our discussions in our Facebook group or follow us on Twitter.
Hi there. My name is Richard Griffiths, and in July I've just published a book entitled The Maritime Silk Road, China's Belt and Road at Sea. I was writing the last words just as the coronavirus pandemic was beginning to spread from Asia to Western Europe and then across the world. Few at that time could have envisaged the ramifications that this would have for the global economy. For that reason, I stopped writing and resolved to keep my readers up to date through the means of these podcasts. When I stopped writing, the official global death toll, which probably underestimates the number of victims, stood at 67,000. Now, at the beginning of July, it stands at nearly 520,000, and it shows no signs of stopping its relentless progress anytime soon. However, for the moment, its intensity in both Asia and Europe seems to have diminished. Now, it's difficult to foresee the impact that this pandemic will have on the social, political, and economic structures of the world, and how far its citizens will lay their losses and their grief at the doors of their leaders. For many branches of the shipping industry, 2019 had been a promising year as it started to shake off the capacity overhang that had appeared after the 2008 financial crisis and subsequent depression. However, as the virus raged through the world, governments responded by taking measures to prevent its transmission by reducing human contact. And that was only something that they could do by shutting down parts of their economy. The impact of the early onset of the pandemic in China and the severity of the measures that had been taken to contain its progress is apparent in its industrial output performance. Now, I'm following industrial output rather than GDP because it's more closely related to the demand and supply of traded goods, which, after all, is the core business of the Maritime Silk Road. So by March 2020, the industrial output of China had fallen by over 25% compared with 3 months earlier. But then it started to recover. The downturns in Japan and Korea were far less severe, falling by 10.5% and 6.5% respectively. Europe's collapse was later than that of China, but it was equally catastrophic. On the other hand, its rebound in May and June has been sharper than that recorded in China. By all accounts, the world was passing through the steepest recession in almost a century. It is inevitable that the economic implosion that characterized Europe and the Far East would have an impact on international shipping. So let's start with looking at container traffic. Containers usually carry relatively high-value, semi-manufactured components and finished consumer goods. They account for virtually 70% of the world's seaborne cargo by value, although less than a quarter by volume. But it's also one of the most intensely studied sectors of the industry. Let us look first at one of the more accessible of the performance indicators, the Shanghai Containerized Freight Index. This concentrates on the more long-distance routes to and from China. And I've placed the data for the first 6 months of 2019 and 2020 next to each other. Now you'll notice there's usually a spike in freight rates in the run-up to the Chinese spring holiday, followed by a return to normal by the start of spring itself. And this pattern is visible in both graphs. The only exception this year is that the new plateau reached is significantly higher than last year, and it continues to climb. Now, given the interruptions in industrial activity, this is surprising to say the least. And there are several possible explanations for this phenomenon. The first is that the Shanghai data includes more trades than the Europe Far East routes, for example, the Trans-Pacific trades, and it also excludes the data from Japan and Korea. The second explanation, however, is that the container traffic between Europe and the Far East was less affected by the fall in industrial output than we might imagine. Overall, the number of containers carried from Europe to the Far East in the first half of 2020 was only 4.5% less than it had been in the similar period the previous year. The number carried in the opposite direction fell by only 8.1%. Nonetheless, there was a fall, and on these routes too, freight rates for the most part remained higher than those prevailing the previous year. So the third explanation is that the ship operators had responded to the fall in demand by blanking sailings, in other words, deleting ships from the schedules, and by slow steaming, reducing the speeds of the ships. Now, both of these served to remove capacity from the market. In June 2020, about 11% of the container capacity was still removed from the shipping market. And the figure, of course, had been higher earlier in the year. Now, this sort of activity is only possible because of the structure of shipping alliances. And this would allow the loss from an individual cancellation to be redistributed among the other members of the association. So it's no surprise that the exemption status from the anti-cartel legislation that the associations enjoy is now, once again, being called into question. Now, of all the sectors of shipping, the real roller coaster of late has been in the market for oil tankers. The graph that you can see has been prepared by the Baltic and International Maritime Council, and it shows three sizes of tankers. The trend of the largest of these is the most interesting. These are the VLCC, the very large crude carriers, and they are capable of carrying between 200,000 and 400,000 tons each. As with the rest of the industry, the oil tanker sector had seen improved performance during 2019. And then, in October 2019, you can see a sharp spike in freight rates. Now, this is a result of the imposition of sanctions by the United States on oil tankers, seen as violating its ban on oil trade with Iran and Venezuela. This had the effect of removing 300 oil tankers from the market, which produced a scramble for the rest of the existing capacity. Now then, the rates usually fall off at the start of the year, and of course the spike of the previous October exaggerates that trend. But then, in February 2020, there's an unusually steep collapse. Now, this is only partly a reaction to an anticipated fall in demand. A high level of remaining stocks had stayed due to the slowdown in economic activity. But it's more a reaction to the removal of the earlier sanctions on the Chinese tankers, restoring capacity to a market that was already glutted, a sort of reverse spike. And then, in the middle of all the doom and gloom, in March, there's an abrupt change in direction. So where does this sudden renewed spike come from? Well, that's a reaction to the sudden availability of ultra-cheap oil as a result of a standoff between Saudi Arabia and Russia over the responsibility for propping up oil prices. Saudi Arabia expanded its output and oil prices tumbled. And suddenly, oil tankers ceased to be a means of transport and became a vehicle for storage as owners were waiting for an upturn of prices, which would then allow the oil to be offloaded at vast profits. By the end of May 2020, some 200 million tons of oil was still being held in floating storage. By then, however, the party was over. Output in OPEC and the United States was reduced, and slowly the capacity that had been locked up in storage returned to the market, and freight rates returned then to more normal levels. The dry bulk sector carries low-value dry raw materials. It accounts for half of the volume of freight carried by sea, and half of that is made up of two commodities, coal and iron ore. Much of this trade is destined for Asia. Now, the index that you can see is the so-called Baltic Dry Index, and it's a composite index measuring the price of different dry goods by sea. It's almost a relief to find an index performing in line with what you'd expect from market conditions. Like the container traffic, this sector too had been improving steadily, and in August last year the index had reached 2,440, its highest point for almost 9 years. Now the index usually declines for a couple of months in December onwards in anticipation of the Chinese New Year holidays, but the collapse since then has been as brutal as it has been precipitous, as the stalling of the Chinese economy reduced the demand for iron and coal and other raw materials. In March 2020, the index touched 262. But then, as industrial activity resumed, it recovered rapidly to reach 1,770 by the end of June. I want to finish by drawing your attention to one of the less visible effects of the COVID pandemic, the impact on the crews. At any point in time, there are some 60,000 ships at sea, employing possibly 500,000 seafarers. Most crews sign on for 6 to 9 months, and then provided with a flight home. But as countries restricted the access of foreigners into their own countries, so crews were unable to return home when their contracts ended, or even to leave their ships. Now, emergency measures have been taken to allow them to continue their work beyond the end of their contracts, but the simple fact is that most do not want to. At the last count, 250,000 seafarers were at least 1 month beyond the duration of their contracts, confined to their ships with no certainty when they can return home. The result of this ranged from fatigue to depression and to an increasing but undisclosed number of suicides. And at the time of making this recording, there was no sign when this issue will be resolved. Well, I hope that you've enjoyed this broadcast. The music was composed by Janet Zado, director of the Florence Youth Orchestra, and you can discover details of how to contact us on the next slide, and I look forward to seeing you again here sometime soon. Goodbye.